In this video, we're going to learn about testable hypotheses, including what it is and how we go about creating it. And we'll also talk about the core hypotheses that we're going to be working with for the rest of the course after developing them together and creating them together in this particular video. But before we start, just a quick recap. Recall that we said data-driven investing essentially involves creating and implementing investment strategies that are statistically valid or statistically sound. And we talked about this 5-step systematic process for data-driven investing, where we start by developing an investment idea or a thesis, and we then move on to creating a testable hypothesis. But importantly, there is a little bit of a step before that in that we transform or translate the investment idea into research questions and then create the testable hypotheses. And once we do that, we can then get on to the good stuff of extracting and cleaning relevant data, estimating our relevant measures, and of course, finally testing and validating the hypotheses so we know whether or not an investment idea has merit and whether it's worth our while. Okay, so we have our investment ideas and indeed we've translated them into research questions. So let's now think about how we go about creating a testable hypothesis. Firstly, of course, what exactly is a testable hypothesis? Well, it's essentially just a formal way of expressing an idea or notion or a hunch that we might have. Now, you might well be thinking, well, how is that different to the research question? Because that is, of course, also a formal way of expressing an idea or a notion. The key difference between a research question and a testable hypothesis is the fact that the research question is a question, right? Hence the name research question. A testable hypothesis will tend to be more of a statement, right? So rather than posing a question, we pose a statement, of what we expect the result to be. It's not something that's proven yet. It's not something that we know for sure, but it's what we expect to see in the data. Okay, and this is actually going to make far more sense when we actually look at hypotheses and when we develop our own hypotheses. But for now, your key takeaway is just the fact that a testable hypothesis is essentially just a formal way of expressing an idea or a notion or a hunch. And it's different from a research question in that it's a statement and not a question. Okay, now it's formal because we can actually test and validate this statement statistically. Right, so we can test and validate the statement empirically, working with real-world data. Now, in addition to being a statement, a hypothesis should be short, ultra-specific, and testable. And by testable, of course, we just mean that there must be a way for us to measure or quantify the hunch, right? So we can't create a hypothesis about something that can't even be measured. Because if you can't measure it, then how exactly are you going to test and validate it? Right, so it needs to be short, it needs to be ultra-specific, and it needs to be testable. And although we've got three sort of characteristics of the hypothesis, so short, ultra-specific, and testable, personally, I think the latter two are more important, right? So, of course, it must be testable in that, like we just said, if you can't test it, if you can't measure it, then you can't test it and you can't validate it. Between shortness and ultra-specificity, I'd go with and recommend you to go with specificity, right? So if you had to choose between a hypothesis being either short, but, a tad bit less specific, or long, but more specific, well, you should opt for the longer but more specific form. Right, so between the length of the hypotheses being short or long versus specificity of the hypotheses, you want to prioritize the specificity of the hypotheses, right? So the more specific your hypothesis, the better it is. And that's ultimately because the more specific your hypothesis is, the more systematic and comprehensive your test for the hypotheses can actually be. Okay, so again, a hypothesis must, of course, be testable. It should be ultra-specific, and ideally, it should also be short. But, we can sort of turn a little bit of a blind eye there and have a little bit of a longer hypothesis as long as it's ultra-specific and, of course, testable. Now, in our specific case, recall that we started with some core investment ideas and themes along the lines of corporate governance, environmental responsibility, and social responsibility mattering for investment purposes. Right, so we talked about the conversation I had with a mate of mine, as well as anecdotal evidence from forums, and of course what's available and established in the research literature. And so, the core sort of ideas were about the relevance and importance of corporate governance, environmental responsibility, and social responsibility, of course, in the context of investments, right? So in the context of investing strategies, if you like. So we started with these investment ideas or themes, and then we translated them into relatively more formal research questions, right? So we said the first question is there any relationship between corporate governance, environmental and social responsibility, and stock returns and risk? And the second question was that if there is some sort of relationship, then can we exploit that relationship to earn abnormal returns? In other words, can we exploit that relationship to earn a return that is greater than the return we could earn by simply investing in the market portfolio or a stock market index? And now that we have this somewhat clear research questions, we can translate and transform these further into testable hypotheses. Now, importantly, there's quite a bit of a mouthful here in that we're looking at three separate factors, including corporate governance risk, environmental risk, and of course, social risk, right? So it would be a bit of a pain if we had to refer to these individually each and every time, especially because we're looking at all three together, right? So we're looking at all three of these different factors. And it just so happens that many other people have also considered these three factors together and indeed individually. And there's a pretty massive body of research, of the literature in these specific areas. And so if you look at the literature on corporate governance or sustainability or, environmental research or corporate social responsibility, then you'll see researchers and practitioners talking about this thing called ESG. Okay, so the three factors combined, so environmental responsibility, social responsibility, and governance, the three of them together are often denoted as ESG. And, I am actually doing a little bit of a disservice here in that ESG is practically, you could see it as an entire field in and of itself, right? So ESG is a massively well-researched and actively researched area. And so, I'm trying to be a bit careful with how I describe ESG because, I don't want to undermine the literature on ESG. But I want to remind us again that in our context, we're not really seeing this from a sort of environmentally important context, right? And we're not really seeing this from a sustainability standpoint or a corporate social responsibility standpoint. Because ultimately, we're just seeing this ESG factor, we're just seeing it as a route for investments, right? So we're seeing it as something that may help us develop a data-driven investment strategy. And so we're seeing it purely from an economic lens, purely from an investment or investing lens, right? So we're not thinking about it as a separate field. And that is why I'm not really going into much detail or much information about, what exactly ESG is and what the history of it is and what the current research shows, etc., etc. For our context, it's sufficient for us to know that the three factors that we're considering, so environmental responsibility, social responsibility, and governance, these three factors combined are often denoted as ESG. Okay, and so going forward, when we talk about the three factors that we're interested in, we'll use the term ESG. Now, if we think about ESG as a sort of risk, ESG is often measured and reported as a type of risk, right? And it's often called ESG risk or ESG score. And in this context, if we think about ESG risk, So if we say, the ESG risk of a stock or firm is high, then that would imply or suggest that the firm has poor governance, right, or bad governance, or that its governance is not good, right? Its corporate governance is quite poor. And similarly, right, so we'd expect if the ESG risk of a firm is high, then its social responsibility is quite poor, right? And the same thing with its environmental responsibility. So the point is that there's ESG itself, which is environmental, social, and governance factors, if you like, or talking about those attributes or those areas. And then there's ESG risk, right? So that's the risk of, say, poor governance or poor environmental responsibility or poor social responsibility, if you like. And while there are a whole host of different ESG measures, generally speaking, a higher ESG score implies weaker governance, weaker environmental and social responsibility, right? And a low ESG risk score implies stronger governance and stronger environmental and social responsibility. Right, so again, this comes back to what I was saying earlier. If a firm has high ESG risk, then we would say that this is a firm that has poor governance, right, or is not environmentally responsible or is not socially responsible. And equally, if a firm had a low ESG risk score or a low ESG score, that would imply that the firm has strong governance or good governance. And the firm is environmentally responsible and it is socially responsible. Again, I do want to specify and be absolutely clear that I am fully aware that I am almost certainly doing a little bit of a disservice to the ESG community and researchers in ESG. But, the context here is data-driven investing, right? So we're seeing things purely from an investment perspective or purely from an economic lens. And so we're not really going to dive deep into the history of ESG or the theory of ESG and, the active research of ESG. Instead, we're going to sort of assume that the researchers have done their dues. So they've done their due diligence and they've created this ESG risk score diligently. And we're then going to use that ESG risk to basically explore and test our hypotheses and potentially create some sort of investment strategy. Okay, so with that hopefully clear, and with a sort of understanding of our research questions and this ESG risk, we can now think about formalizing our research questions into testable hypotheses. Okay, and the way we want to do this, not just for this particular hypothesis, but for any hypotheses that you're looking to create, we want to start by thinking about what we expect to see. In other words, we want to start by thinking about what we think the answer to the research questions will be. Right? So in our case, our first research question was, is there some sort of relationship between ESG and stock returns and or risk? Right? And so for that particular research question, it's plausible to think that ESG risk and expected returns have a proportional relationship, right? Because remember, we're saying the higher the ESG risk, the worse the company's governance, right? The worse its social responsibility, the worse its environmental responsibility. So the higher the ESG risk, the worse the firm is in the context of its governance and environmental and social responsibility. And so we know, for instance, from exploring the relationships between price, risk, and return at the very start of this course, that expected returns and risk maintain a proportional relationship. Now, in that particular video, when we were exploring the relationships between expected returns and risk, we were talking about total risk, right? Or the implicit assumption, the implicit context was total risk. But we also talked about the fact that there are hundreds of different measures of risk, right? So ESG risk here is just one other measure of the risk of a firm. And so naturally, of course, you'd expect that relationship to still hold. Expected returns and risk maintain a proportional relationship or have a proportional relationship. And so ESG risk and expected returns should also maintain a proportional relationship. Put simply, of course, the higher the ESG risk, the greater the return investors would or should demand. right? Because you're taking on a risk as an investor and you want to be compensated for that risk. So if a firm displays higher ESG risk, then you're only going to invest in that firm if you're compensated for the risk of investing in that firm. Now, normally when we talk about compensation for risk, we would talk about it in the context of total risk or market risk or perhaps firm-specific risk if we're not dealing with diversified portfolios. But, the fundamental idea is compensation for risk. And so the higher the ESG risk, the greater the expected return or the greater the return that investors would or should demand. And so the expectation here is that ESG risk and expected returns have a proportional relationship. Importantly, I'm not saying that they definitively have a proportional relationship, right? I can't necessarily conclude that just yet because, we haven't really seen it in the data. In fact, we haven't explored any data relating to ESG and expected returns as of now. But intuitively, this is what we would expect in the context of ESG risk and expected returns. Similarly, we would expect intuitively, and we would think that ESG risk and total risk have a proportional relationship, right? Because they're both kinds of risk, and the worse the governance of a firm, for instance, the weaker its corporate governance, the more likely it is to take part in fraudulent activities, for instance, right? And naturally, of course, fraudulent activities is a pretty massive firm-specific risk, and firm-specific risk is a part of total risk, right? So you'd kind of expect ESG and total risk to have a proportional relationship. I mean, if we think about the opposite effect, so an inverse relationship, why would you expect there to be an inverse relationship between the two, right? Because for that to be true, what that would imply is that the worse a firm's governance, the lower its risk, right? Because the worse a firm's governance, the higher the ESG risk, because remember, ESG risk is greater for firms with weaker governance. So if we say that ESG risk and total risk have an inverse relationship, then we would be implying that the weaker the governance of a firm, the less risky the firm is from a total risk standpoint. And the stronger the governance of a firm, the stronger or better a firm's corporate governance measures are, the more risky the firm is, right? And of course, that doesn't quite make intuitive sense. And so at this stage, purely from an intuition standpoint, it seems more plausible and reasonable to expect that ESG risk and total risk will have a proportional relationship. Importantly, of course, we still don't quite know this for sure. We'll only know that when we look at the data. But the idea is the higher the ESG risk of the firm, the higher the firm-specific risk of the firm, and therefore the higher the total risk of the stock. Okay, hopefully that makes sense. So now that we have some sort of an expectation or an idea about what we expect to see once we've answered the research questions, so what we expect the answers of the research questions to be, we can now essentially state these expectations in the form of a hypothesis, right? And that looks something like this. So we can say H1, our first hypothesis, is that there's a positive relationship between ESG risk and expected returns, right? And again, this is because we're saying the higher the ESG risk, the greater the return that investors will demand. And so because we expect ESG risk and expected returns to have a proportional relationship, our hypothesis is that there is a positive relationship between ESG risk and expected returns. Importantly, and I really can't stress this enough, although it looks like a conclusive statement, like a definitive statement, it is anything but, right? Because this is a hypothesis. So we're hypothesizing that this statement holds, that there is a positive relationship between ESG risk and expected returns. Okay, so this is our first hypothesis. And the second hypothesis is that there's a positive relationship between ESG risk and total risk. And again, this is because we're relying on the premise that the higher the ESG risk, the greater the firm-specific risk of the stock or the firm, and the greater the firm-specific risk, the greater the total risk of the firm as well. Okay, so we now have two hypotheses, both of which relate to the first research question. Now, once we test these hypotheses, we'll know whether or not these statements hold, right? So we'll know whether or not these hypotheses are valid. And assuming that we find that these hypotheses are in fact valid, that these statements are in fact true, then that would imply that we can answer affirmatively to the first research question, right? Because we'd be able to show and demonstrate that there is a positive relationship between ESG risk and expected returns and/or the risk of stocks. Now, assuming that that is the case, in other words, assuming the first research question is in fact answered affirmatively, then we might expect firms with greater ESG risk to outperform those with weaker ESG risk. Why? Because remember, what's our first hypothesis? Is that there's a positive relationship between ESG risk and expected returns. So we're hypothesizing that the greater the ESG risk, the worse a firm's corporate governance, the greater the expected returns of that stock or of that firm. This, importantly, is on the premise that risk and expected returns maintain a proportional relationship. You might, of course, equally argue that, hey, if a firm has a significantly high ESG risk, then, we're not really going to invest in that firm whatsoever. The demand for that firm is going to be a lot lower, and so expected returns are also going to be lower. Okay, and that would be a very valid argument. Okay, so that's just a different way of looking at the relationship between ESG risk and expected returns. But what we're saying is if and only if this hypothesis, H1, is proven, is validated, right? So if we see that there is a positive relationship between ESG risk and expected returns, then that means the higher the ESG risk, the higher the expected returns. And if that is in fact the case, then you'd expect that firms with a higher ESG risk will outperform those firms with a lower ESG risk, right? Because the greater the ESG risk, the greater the expected return, the lower the ESG risk, the lower the expected return. And so if and only if the first research question is answered affirmatively, hypothesis 1 in particular is validated as is shown to be true, then and only then we might expect firms with greater ESG risk to outperform those with weaker ESG risk. And if that is in fact the case, then we can say that we hypothesize that the returns of firms with higher ESG risk are statistically greater than the returns of firms with lower ESG risk. Right? Because this is basically just saying the same thing I've just said before. The higher the ESG risk, the higher the expected return. The lower the ESG risk, the lower the expected return. If that is true, if that is in fact the case, then we would expect to see that the returns of firms with higher ESG risk are in fact greater, but not just greater as is, they need to be statistically greater than the returns of firms with lower or weaker ESG risk. And what I highlight again, we're not saying this is definitively true, we're hypothesizing that this might be the case. Okay, and again, this is on the premise that firms with higher ESG risk outperform those with lower ESG risk because investors are getting compensated for the firm's poorer ESG responsibility, right? So firms need to compensate investors, or firms with higher ESG risk need to compensate investors because their governance is poor, because their environmental responsibility is poor, and because they're not socially responsible or their social responsibility is low. Now, remember that the research question that we posed, the second research question, was that if there is a relationship between ESG and stock returns and risk, then can we earn abnormal returns using this sort of ESG, right? So can we earn abnormal returns by exploiting the relationship between ESG and stock returns and or risk? This particular hypothesis says nothing about earning abnormal returns, right? All it's showing or all it's testing for is whether the returns of firms with higher ESG risk are statistically greater than the returns of firms with lower ESG risk. It doesn't say whether these returns are going to be higher than what we could earn by investing in the market portfolio or in the stock market index. So that's where the fourth and final hypothesis comes in. H4 says that a long-short ESG risk strategy yields abnormal returns. Okay, importantly again, remember, and I appreciate I'm saying this over and over and over again, but it's only because I can't stress the importance enough. Although this looks like a definitive and conclusive statement, remember it is purely and only a hypothesis. So we're hypothesizing that a long-short strategy based on ESG risk will yield abnormal returns. Now, what is a long-short strategy? It essentially means that we would go long in stocks with high ESG risk, and we would short firms with low ESG risk. I appreciate that for some of you, this may well be sounding particularly complicated, but please don't let it kind of freak you out. Don't worry about understanding long versus short right now, or this long-short ESG risk strategy, because, this is hypothesis 4, right? It's the fourth and final hypothesis, and we've got quite a long way before we actually get to testing this particular hypothesis. Okay, so you'll have plenty of time to understand how such a strategy would work, and we'll talk about that much later on when we actually get around to prepping our data for this particular hypothesis. For now, your key takeaway is that this particular hypothesis will allow us to see whether or not we can, in fact, earn abnormal returns or earn a return that's higher than the market portfolio by exploiting the relationship between ESG, or strictly ESG risk, and expected returns of stocks. Now, before we close off, and I appreciate, there's already quite a lot of information in this particular video, but it's important that we do also cover one final technicality, because we've kind of gone away from what's strictly correct in talking about these hypotheses. Okay, so just bear with me for a bit while I clarify the technical error in the way we've described the hypotheses and why that technical error isn't really that much of a problem. Okay, so we've talked about these hypotheses and creating testable hypotheses. Strictly speaking, hypotheses should have what's called a null and an alternative. Okay, and the null hypothesis, or simply null, is often denoted H0 or H0, and an alternative, or the alternative hypothesis, is often denoted H1. Okay, and it's also often written out as H subscript 0 and H subscript 1. And in fact, this is the notation I'm going to be using in the next few slides, because, I don't want to confuse you with H1, because, of course, in our case, H1 relates to the first hypothesis, not this sort of null versus alternative. Okay, so if you just focus your eyes on this particular symbol here and this one over here, H0, H subscript 0, strictly speaking, relates to what's called the null hypothesis, and H subscript 1, strictly speaking, relates to what's called the alternative hypothesis. Now, strictly speaking, the null hypothesis represents what's called the status quo, okay, or it represents what's known. And the alternative hypothesis, or H1, represents what you'd see if you could reject the status quo. Now, in the context of our specific hypotheses, in the context of exploring the impact of ESG for investment analysis, the status quo is that ESG does not matter. Okay, this is importantly, of course, assuming that you're speaking to people from asset pricing within finance. If you speak to people who are involved in corporate governance or those involved in corporate finance within finance, then they'll tell you differently, right? So they'll tell you that ESG does in fact matter. But purely from an investing standpoint, purely from an asset pricing standpoint, ESG shouldn't really matter. And so that's the status quo if you're speaking to people from an asset pricing perspective or standpoint. Okay, and this is kind of why when we talked about, the relevance of investment ideas, when we talked about developing investment ideas, I said it's important to keep in mind that the relevance depends on who you're speaking to, right, or who you're speaking with. And so that's kind of what we're seeing over here. If we think about things purely from a data-driven investing standpoint where, asset pricing is most relevant, then the status quo suggests that ESG does not matter. And given that that's the status quo, the strictly correct way of writing out H3, for example, our third hypothesis, would be to say that the null hypothesis is that the returns of firms with higher ESG risk are statistically equal to the returns of firms with lower ESG risk. And the alternative hypothesis is that the returns of firms with higher ESG risk are statistically greater than the returns of firms with lower ESG risk. Okay, now, again, this is not the only way you could say it, because, if, for example, you speak with people in corporate finance or corporate governance particularly, then, they might take the argument that we spoke about earlier in this video. So, we talked about this idea that firms with high ESG risk may be so unattractive for investors that they may simply choose to avoid investing in those firms. And if that happens, if that's true, you might argue that the demand for investing in those securities is incredibly low, and so the expected returns of those firms is also low. And in that case, you would expect, for example, the status quo would tell you that the returns of firms with higher ESG risk are statistically lower than the returns of firms with lower ESG risk, right? Because then we would say that those firms with a higher ESG risk are not attractive to investors. The expected returns are lower, so they would underperform firms with lower ESG risk. Okay, it really all depends on who you speak to. But the point is that the null hypothesis, strictly speaking, should reflect the status quo. Of course, the status quo depends and varies based on who you're speaking with, right? But the key idea for you is that the null hypothesis represents the status quo, and the alternative represents the challenge to the status quo. So within the context of, say, asset pricing, if we're speaking to people in asset pricing, we challenge the status quo by saying returns of firms with higher ESG risk are statistically greater than the returns of firms with lower ESG risk. Equally, we could even challenge the status quo by saying that they're not equal, right? So we could challenge the status quo by saying returns of firms with higher ESG risk are statistically different to the returns of firms with lower ESG risk. And that would still challenge the status quo, because the status quo here is that the returns of these two groups of firms should be equal, right, or statistically equal. On the flip side, if you were speaking to people, with a corporate governance background or corporate finance even, then you might challenge the status quo by simply saying this thing, right? Because this is implying that the returns of firms with higher ESG risk are statistically greater than the returns of firms with lower ESG risk. Whereas the folks in corporate governance and corporate finance would say that the status quo is that the returns of firms with higher ESG risk are statistically lower than the returns of firms with lower ESG risk. Okay, I sincerely hope that that's quite clear. I appreciate, there's been a lot of lower ESG risk and higher ESG risk and, this person's opinion and, that group's opinion and status quos and what have you not. Really, the key idea that you need to take away is that a testable hypothesis is essentially a statement about what we expect to see in the data. Right? It's a statement that challenges the status quo. It's a statement about our expectations about the answer to our research question. And it is also reasonably acceptable for you to not explicitly state hypotheses in this way, so null versus alternative. It's reasonably acceptable to exclusively express the hypotheses as the alternative, right? And that's the approach we took, and indeed the approach we're going to continue to take, because it just makes it easier and indeed more intuitive to merely state what we expect to find in the data, right? To talk about what we expect to see once we test and validate our hypotheses, or indeed describe it as the answer that we expect to see to our research questions. Okay, and I say it's reasonably acceptable not just because I think so and say so, But because if you were to look at the relatively more recent research literature, be that in academia, be that in the practitioner world, you'll find that it's pretty common and almost common practice, at least, to exclusively express their hypotheses as the alternative hypotheses, right? So talk about what they expect to see, and then basically just say whether they find evidence to support their hypotheses or not. Okay, just to wrap up then, going forward, we're going to be working with the following 4 hypotheses. H1, there is a positive relationship between ESG risk and expected returns. H2, there is a positive relationship between ESG risk and total risk. H3, returns of firms with higher ESG risk are statistically greater than the returns of firms with lower ESG risk. And finally, to answer our second research question, H4, a long-short ESG risk strategy yields abnormal returns. Now, again, with this particular point, I know that I haven't gone into as much detail, but I really believe you've had enough for one particular video. There's been quite a lot of information in this particular video, so we'll touch base on this thing again later on in the course. For now, though, just a quick summary. We learned that a testable hypothesis is essentially just a statement which expresses or formally expresses an idea or notion or hunch in a way that allows statistical validation. We learned that a hypothesis should be short, ultra-specific, and testable, meaning that we should be able to quantify our hunch. And of course, between the length of a hypothesis and its specificity, you want to prioritize specificity. Right? So you'd rather have a longer but more specific hypothesis than having a shorter but less specific or ambiguous hypothesis. Okay. Finally, of course, we learned that strictly speaking, hypotheses should have a null and an alternative, but it is reasonably acceptable to express the hypotheses only using the alternative form. That's the approach that's pretty common in the academic and practitioner literature, and it is the approach that we're going to take for the rest of the course. Hopefully all of this makes sense. Again, I appreciate there's quite a lot of information in this particular video, but if anything doesn't quite make sense, please do rewatch the video, at least in part, if not the whole thing, and be sure that you are in fact clear about our core hypotheses and the underlying intuition and rationale behind our hypotheses. Okay, but that's enough from me for now. Have a go at the quiz, and I'll see you in the next video.